There's a pattern in history that almost nobody sees while it's happening. On the surface, it looks like recovery, reform, clever policy. Underneath, it's something else entirely. A slow, deliberate transfer of wealth from citizens to the state, from savers to debtors, from the many to the few. And right now, in the mid-2020s, the United States is walking through that pattern, step by step, basis point by basis point, almost like it's reading from a script that's been used before. In ancient Rome, the silver coin called the denarius held the empire together. Soldiers were paid in it, merchants trusted it, taxes were collected in it. Then the empire got overextended. Too many wars, too many promises, too many payouts. The emperors had a choice: admit they couldn't pay or quietly cheat. They chose the third path. They didn't default on the coins. They changed the coins. Silver content went from almost pure to barely there. Prices exploded, trust collapsed, the empire followed. In Weimar Germany, after World War I, the story rhymed. The government owed impossible reparations and domestic debts. There was no way to pay in honest money, so they printed. At first, it felt like a solution. Factories hummed, unemployment fell. Then the math caught up. A loaf of bread went from 1 mark to 100 billion marks in less than a decade. People burned banknotes for heat. Middle-class life savings gone. Government debt, conveniently, also gone. And in the United States, in the 1930s, a quieter version played out. The country was suffocating under Depression-era debt and deflation. Gold was money. Dollars were legally defined as a claim on gold at a fixed price. Then one signature changed the rules. Gold ownership was banned. The price was redefined upward. The government booked a windfall on its own gold reserves. Citizens holding paper dollars felt richer for a moment, then watched their purchasing power erode over the next decade, while the state's real debt burden shrank. 3 times, 3 different systems, 3 different ideologies, same outcome. Over-indebted governments did not pay their debts. They changed the meaning of the money those debts were measured in. Here's what should make the hair on the back of your neck stand up. The United States is already deep into the same pattern. Massive debt? Check. Rising interest costs? Check. Political paralysis around taxes and spending cuts? Check. Central banks and governments quietly hoarding hard assets while telling the public everything is fine? Check. Now add one new ingredient that Rome, Weimar, and 1930s America never had. Digital scarcity. A parallel system built on Bitcoin and anchored by gold. That S where this story turns from historical pattern into something you going to feel in your rent, your groceries, your savings account. The headline number is simple, and it's not a conspiracy theory. The United States government owes tens of trillions of dollars. Think about what that actually means for a second. That isn't just some abstract number on a screen in Washington. That is a claim on your future, on your work, on your taxes, on your children's taxes. It's a promise the government has made on your behalf. When your family runs up too much debt, you know what you have to do. You work more, you spend less, you sell things, you grind for years until the numbers shrink. That's how household debt works. Painful, visible, honest. Government debt is not like that. When a sovereign controls its own currency, it has a weapon you will never have. It doesn't just owe in the unit of account. It defines the unit of account. It writes the dictionary that tells you what $1 even means. That's the entire game. If you owe 37 trillion in a currency you can print and you have the political power to redefine what that currency is worth, do you really have to pay it back? Or do you just have to convince the public that something smart and necessary is happening while the real value of what you owe quietly melts away? This is the core of the modern playbook. It even has a polite name, a monetary reset. But strip away the branding and you're left with the same brutal mechanic Rome, Weimar, and Depression-era America used. Devalue the money, do not admit default, and make sure the people who trusted you pay the price. Let's be clear about the stakes. When a government gets to the point where interest on its debt is competing with defense, healthcare, and social programs, the math stops being an academic debate. It becomes survival math. You can't tax enough without risking revolt. You can't cut enough without getting voted out or triggering chaos. You can't grow fast enough when the interest bill is growing faster than the economy. So there's one pressure valve left: destroy the real value of the debt. There are two ways to do that. The blunt, obvious way is to print so much money that inflation runs hot for years. Everyone sees it. The currency slides in foreign exchange markets. Bond buyers demand higher yields. Confidence erodes. Politicians hate this version because they get blamed. The sophisticated way is uglier but cleaner from their point of view. You don't admit you're destroying the currency. You tell people you're strengthening it. You say you're returning to sound money. You wrap the same devaluation in the language of responsibility. That's where gold and Bitcoin enter the story. On the surface, gold and crypto look like rebellion. They are marketed as the anti-system, the exit ramp, the hedge against central bank insanity. And in some ways, they are. But step back and look at the pattern. What happens when the same government that issues the money also becomes a massive holder of the thing that is supposed to be protection from that money? You move from citizens hedging against the state to the state hedging against its own currency. Imagine you read the Treasury Secretary staring at a spreadsheet that screams one message: this is not payable in honest dollars. You know you can't come out and say that. You also know that in every historical case, the asset that survives the reset is some form of hard money: land, gold, commodities, things you can't print. In the 2020s, there's now an additional candidate on that list: digital scarcity with a fixed supply. So you start building a parallel balance sheet. Officially, you say nice things about innovation and financial leadership. You commission reports on digital assets. You talk about staying ahead of rivals. You frame it as protecting the future of technology, of payments, of freedom. It plays well in speeches. Quietly, you start doing something very different. You accumulate, sometimes through open market purchases, sometimes through seizures from criminals and tax evasion cases, sometimes by letting people pay fines in the very asset you want to stockpile. You define new categories like strategic digital reserve and monetary metals. You normalize the idea that the state should own a lot of the thing everyone else is trying to buy as protection from the state. This is stage one of the modern reset: accumulation in the shadows while the public thinks it's about modernization. Stage two is psychological. You need people to believe two things at the same time. First, that the existing currency is still safe enough to hold, so they don't panic prematurely. Second, that the new narrative around strategic reserves is patriotic, smart, and necessary in a dangerous world. You talk about rival blocs creating gold-backed settlement systems. You talk about the need for a strong anchor to discipline fiscal policy. You flirt with phrases like partial backing and digital reserve currency. You are not telling them the real reason you need an anchor. You need it because you were going to reprice that anchor and use the accounting gain to pretend your own balance sheet is healthier than it is. If that sounds abstract, think back to 1933, because that's the clearest historical dress rehearsal for what a revaluation actually looks like. Before the Depression, a dollar in the United States was legally defined as a specific amount of gold. There wasn't a fuzzy target. There was a number: $20.67 per ounce. 1 ounce of gold, $20.67. That parity had held for decades. Banknotes were essentially claim tickets on metal in vaults. When the economy imploded and debts became unpayable, the government could have defaulted openly on various obligations. It could have told creditors, "We can't pay." Instead, it went after the underlying definition of the dollar itself. It made private gold ownership illegal. Citizens had to hand in their coins and bars at the old price. Then, once that gold sat safely on government balance sheets, the official price was raised to $35 an ounce. Same metal, same vaults, different number. On paper, the state had just manufactured a huge increase in the nominal value of its reserves. It could now point to its balance sheet and say, "Look, we're stronger, our backing is bigger, we're more solvent." In reality, nothing magical appeared in the world. No new mines were discovered overnight. What changed was the measuring stick. And when you change the measuring stick of money, you are really changing the value of everyone's savings, wages, and debts. That's the heart of a revaluation. It is a hidden tax wrapped in the language of stability. The reason this matters for you today is that the ingredients for a similar move are falling into place again, but with a twist. This time, the potential revaluation assets aren't just gold sitting in Fort Knox. They're also digital units on blockchains that millions of people believe are the future of money. If a government can convince the world that its reserves of those assets are now worth multiples of their previous accounting value, it can do exactly what Roosevelt did in the 1930s, shrink its real debt burden without writing a single honest check. And you are not invited to that party. You are the party. Your savings account is the buffer zone. Your bond fund is the shock absorber. Your paycheck is what gets silently clipped in purchasing power, while headlines congratulate politicians for restoring confidence to the system. This is not some abstract macroeconomic puzzle. It shows up as your rent doubling while your salary lags. It shows up as your grocery bill jumping in 6 months what it used to jump in 6 years. It shows up as your parents' patronage, Etienne's pension checks covering less and less each year, while official statistics swear inflation is under control. If you want to understand what is coming, you can't just stare at the national debt clock and feel overwhelmed by the digits. You have to study the mechanism, the playbook, the stages that repeat. Stage 1, run up an unpayable debt in a currency you control. Stage 2, deny there's a problem, then blame everything except the structure of the system. Stage 3, quietly accumulate hard assets that will survive a reset. Stage 4, engineer or seize on a crisis big enough to justify extraordinary measures. Stage 5, revalue the assets you hold, redefine the currency, and let inflation do the dirty work of erasing what you owe in real terms. History shows this pattern again and again. The only real difference now is the set of tools on the table. Central bank balance sheets loaded with bonds, sovereign gold reserves that are officially understated on the books, and a parallel world of digital scarcity that can be pulled into the system when it's convenient. Right now, you are somewhere between stage 3 and stage 4. And if that sentence makes your stomach drop, good. It should. Because once stage 5 starts, once the revaluation is triggered and the narrative machine spins up to justify it, you don't get to reposition easily. The whole point of a reset is that it happens at a moment when most people are still in psychological denial, when they still think they would never do that here. They already did. Rome did. Weimar did. Roosevelt did. The only question is what the 21st century version looks like when you add Bitcoin, globalized finance, and a middle class that has most of its wealth trapped in financial assets the state can't afford to protect. That's the story you're in. And if you think this is just fear-mongering, keep watching, because in the next part, we're going to walk through the numbers line by line, and you're going to see why, mathematically, the people running the system are being pushed toward one conclusion. Don't pay the debt back. Change the meaning of the money instead. The year is now, not some distant sci-fi future, not a far-off scenario for your grandkids. You're living inside the pressure cooker. You wake up in a country where the government owes more than any state in history has ever owed in peacetime. The number doesn't even feel real anymore. Trillion has become background noise. But the math doesn't care how numb you are. Every 12 months, the government has to roll over mountains of old debt and issue new debt just to keep the machine running. At the same time, it has to pay interest on everything it already borrowed. Think about that for a second. Before it builds a single road, pays a single teacher, or writes a single welfare check, it has to feed the bond market. If interest costs rise to the point where they rival defense, healthcare, or social security, you're not in normal territory anymore. You're in this cannot continue territory. When interest alone eats a big slice of national income, you are not managing debt. You are being managed by it. Households in that situation have one path: pain. They tighten their belts, work more, spend less, move to smaller apartments, sell the second car, maybe even declare bankruptcy. It's brutal, but it's honest. The numbers shrink because people bleed. Governments don't like honesty when it hurts. They don't run side hustles. They don't pick up extra shifts. They don't move from a 5-bedroom house to a studio. They have two levers you don't have: taxation and currency control. They can take more of your nominal income, and they can change what the unit of that income is worth. Taxation has limits. Raise rates too high, and people fight back. They evade, they vote you out, they take their capital elsewhere. There's a point where the political cost of more taxes exceeds the revenue. Cutting spending has limits too. You can only reduce pensions, benefits, and government jobs so much before people protest, strike, or flip the table politically. Every entitlement program has a constituency ready to burn phone lines and flood streets if you threaten it. But currency laws? Most people don't even understand how those work. Changing the rules of the money game is invisible compared to changing their paycheck line. That's why, historically, when the wall closes in, the same pattern emerges. Do as much as possible through the one channel people don't watch closely: monetary structure. In your lifetime, you've already seen the softer versions. Interest rates pinned near zero for years. Central banks swallowing bonds by the trillions under labels like quantitative easing. Quiet shifts in how inflation is measured. None of this is neutral. None of this is random. Every basis point is a political choice. But as the debt pile grows, those soft tools stop being enough. You can only suppress interest rates so far before currency markets and foreign creditors push back. You can only massage inflation statistics for so long before the gap between the official story and grocery aisle reality becomes insulting. At some point, the system needs a reset that's big enough to matter. If you want to understand what that might look like, don't start with Bitcoin. Don't even start with gold. Start with something simpler: accounting. Imagine your government sitting on a huge stash of undervalued assets. On its official books, those assets are recorded at some archaic price from decades ago. Maybe it has a metal sitting in vaults, valued at a statutory price that no longer matches the market. Maybe it's a new digital asset carried at the cost it was acquired, not the price the market would pay today. On paper, those reserves look small relative to the debt. In reality, if you mark them at a higher valuation, they could offset a big chunk of what's owed. If you change one number in the spreadsheet, the official price of the reserve asset, you instantly create hundreds of billions, maybe trillions, in paper wealth for the state. At the same time, you dilute the real value of the liabilities measured in the same unit. That's the simplest way to think about a revaluation. You are not conjuring new oceans of gold or digital tokens. You are changing the ruler you use to measure everything. It's like taking a yardstick and deciding overnight that from now on, 1 yard is defined as 50 inches instead of 36. Suddenly, you owe fewer yards, and your pile of wood is worth more yards, even though neither the wood nor the debt physically moved. In the 1930s, the United States did this with gold openly: confiscate, reprice, inflate, shrink the real burden of the debt, kill the purchasing power of savers quietly over the next decade. Today, The setup is more elaborate. The stage is global. The props include central bank balance sheets, sovereign gold reserves, and a new character, provably scarce digital assets with a fixed supply cap and a narrative of inevitability. Let's say a future administration frames a strategic Bitcoin reserve. The language will be polished. It will mention competitiveness, innovation, national security. It will say nothing about the real end game. You can revalue what you don't own. At first, the amounts will look small. A few 100,000 coins seized from dark web markets, fraud cases, and tax evasion. A few more acquired through fines and settlements. Perhaps some quietly mined using excess energy at government facilities. No need to bid on public exchanges and drive the price up. No need to spook markets. Slow accumulation is the rule. On the metal side, the story is even simpler. The state already has large gold reserves. Some of it is officially valued on balance sheets at prices set half a century ago. The market value might be 10, 20, or 30 times higher than the accounting value. Do you see the setup? A government with unpayable debt, a stash of hard assets carried on the books at artificially low prices, legal and political control over the definition of its own currency, a history of using revaluation to cleanse balance sheets without admitting default. Pattern, pattern, pattern. In normal times, suddenly declaring that your gold reserves are worth 10 times what they were last week, or that your digital reserves are to be treated at some lofty strategic price above market would look ridiculous. Politicians would be mocked. Bond markets would panic. Foreign governments would protest. So you don't do it in normal times. You wait for crisis. You let interest costs climb. You let a debt ceiling fight go right to the edge. You let a few auctions of government debt go badly. You let yields spike just enough to create fear. Headlines about fiscal cliff, default risk, downgrade, commentators warning of a lost decade, and then you step forward with the plan. The plan will not be presented as a wealth transfer or a stealth default. It will be wrapped in phrases like stabilization, long-term sustainability, restoring confidence, anchoring the currency. It will talk about using national reserves of gold, digital assets, and other strategic holdings to strengthen the balance sheet. The actual mechanic will be boring on paper and devastating in real life. On day one, not much feels different. The revaluation happens in spreadsheets, press releases, and central bank statements. The price of the reserve assets is officially marked higher. The state declares that, for accounting and reserve purposes, gold and Bitcoin and other strategic assets are now recognized at new values. Balance sheet transformed, debt to reserve ratios improved, official solvency metrics better. On day one, you still go to work. You still pay for coffee. Your bills don't triple overnight. But the signal has been sent. The largest player in the system has declared that the thing you thought was alternative money is now premium collateral, and that the unit we've been paying you in for years is worth less relative to it. Markets don't ignore that. Over months and years, capital moves, prices adjust, and the person who feels it last and hardest is you. This is where the story leaves spreadsheets and enters your kitchen. In real terms, inflation is the weapon that completes the reset. Once the revaluation changes the reference point for what money is, price structures begin to shift. Imported goods get more expensive. Energy moves first. Food follows. Rents lag, then jump. Wages chase from behind. You don't get a neat announcement that says, "Dear citizen, your savings will lose 60% of their purchasing power over the next 3 years so that we can make our debt load manageable." You get feel-good speeches about resilience and leadership, then a slow-motion mugging at the supermarket. And when you complain, you'll be told that inflation came from supply shocks, geopolitics, corporate greed, climate, everything except the one thing that actually mattered, the conscious decision to solve an impossible debt problem by diluting the value of the currency you live in. If all of this sounds too orchestrated to be real, look back at the historical record. Governments do not usually sit around helplessly when fiscal arithmetic turns ugly. They act, and their actions follow a pattern because their constraints are similar: big debts, angry voters, limited appetite for overt pain, control over money. There are only so many doors out of that room. Now let's zoom back into the current architecture, because this isn't happening in a vacuum. It's happening in a world where money isn't just coins and paper anymore. It's code, networks, and ledgers spread across the globe. On one side, you have the legacy system: central banks, commercial banks, government bonds, fiat currencies. On the other, you have the emergent system: Bitcoin, other scarce digital assets, private stablecoins, offshore payment rails, gold moving quietly between central bank vaults. You're standing in the middle. If you listen to official speeches, you'll hear two seemingly conflicting messages. On the one hand, authorities warn you about the dangers of crypto: money laundering, scams, terrorism, instability. On the other hand, they talk about embracing innovation, exploring central bank digital currencies, integrating digital assets into the financial system. It sounds contradictory until you realize the line they're drawing. They are hostile to forms of digital money they don't control. They are very interested in forms of digital money they can weaponize, either as tools of surveillance and control, or as assets they can revalue to mop up their own debt. Gold plays a similar dual role. Publicly, it's old-fashioned, barely mentioned, a relic. Privately, central banks around the world quietly buy it in ton after ton, year after year, record purchases. Why? Not because they have a sudden nostalgic feeling for shiny metal, but because gold is the one monetary asset that is nobody's liability. In a world of IOUs, it's the thing that just sits there. Now imagine you're watching this from the balcony, not from inside the news cycle. What do you see? You see governments with unsustainable debt loads. You see central banks expanding their balance sheets massively over the last decade. You see gold purchases by those same central banks hitting multi-decade highs. You see a new asset, digital, borderless, fixed in supply, that powerful players quietly accumulate even as they warn the public away. The pattern is hard to ignore. Let's walk through a stylized version of how a dual revaluation could work. Not as prophecy, but as a blueprint. Because whether the numbers are exactly this or not, the logic is what matters. Step 1. Accumulation phase. Over several years, the state increases its holdings of gold and digital reserves. It doesn't flaunt the totals. It dribbles out partial information. It seizes coins in law enforcement actions and quietly transfers them to treasury wallets. It keeps statutory gold valuations on the books low, even as market prices rise, preserving a huge gap it can later close in a single stroke. Step 2. Narrative phase. Politicians and central bankers begin to talk more often about anchoring the currency. They mention the dangers of a fragmented global monetary order. They highlight rival blocs, discussing gold-backed settlement systems or commodity-linked currencies. They warn that if we don't act, they will write the next chapter of monetary history. You're not hearing about revaluation yet. You're hearing about responsibility and stability. Step 3. Crisis trigger. Maybe it's a debt ceiling standoff that goes too far. Maybe it's a downgrade by a major rating agency. Maybe it's a bond auction that fails, forcing yields higher. Maybe it's a geopolitical shock that sends investors fleeing from government debt. Whatever the specific spark, the effect is the same. The status quo stops looking safe. Journalists start asking whether the government can sustain current debt levels. Economists float phrases like fiscal dominance, meaning policy is now driven by the need to manage debt, not to manage the real economy. Step 4. The solution. In this environment, a national monetary stabilization plan doesn't sound crazy anymore. It sounds like leadership. It sounds like someone finally doing something. The plan might include the following elements: an official declaration of a strategic gold reserve backing a fraction of the currency, a formal recognition of a strategic digital reserve with Bitcoin as its core component, a change in the statutory price at which gold is valued on government books, lifting it many multiples above the old level, an internal accounting rule that values the digital reserve at a strategic price well above market, justified by long-term fundamentals, and scarcity. On the day of the announcement, technocrats step in front of cameras with charts and models. They explain how the new valuations dramatically improve the government's balance sheet. They show you ratios of reserves to debt that look less frightening. They talk about restoring confidence and protecting the value of the currency over the long term. What they want to spell out is the flip side. For these new ratios to be meaningful, the purchasing power of the currency you spend has to erode. Otherwise, the accounting trick stays just that, an internal illusion with no real bite. The revaluation doesn't work in isolation. It works when it's coupled with years of above-target inflation that slowly reduces the real burden of the debt. Step 5. Repricing the world. Once the largest economy on Earth declares that its core hard assets are to be treated at much higher values, the rest of the world can't ignore it. Either they protest and refuse, or they quietly do something similar themselves. History suggests coordination, not resistance. Other central banks mark up their own gold. They acknowledge their digital holdings at higher internal valuations. Bond markets, sensing the direction of travel, demand higher interest to hold any debt that will be repaid in softened currency. Savers, too late, scramble for assets that can't be conjured by decree. Where are you in all this? You are standing at the checkout line, noticing that what used to be a week of groceries now looks like half a cart. You reopening your pay stub and realizing your nominal raise is smaller than the jump in your rent. You rewatching headlines about record highs in stock markets that don't make you feel richer, because your real life is getting more expensive faster than your investments are growing. If you hold bonds, especially long-term government bonds, you're on the wrong side of the trade. You are effectively lending hard-earned purchasing power into a system that plans to ship back something weaker. If you sit in cash because it feels safe, you're watching that safety evaporate in silence. No flashing red numbers, no margin call, just quiet decay every time you tap your card. And the people who are doing better, they're the ones who own the very assets being revalued upward, or the real stuff that adjusts prices alongside them. Land, productive businesses, scarcity. This is where the story intersects with morality, because it's not just a technical maneuver. It's a choice about who eats the cost of decades of bad policy. So who actually pays for a sovereign debt problem that gets solved through revaluation and inflation? History is cruelly consistent. The winners are the entities closest to the spigot and the reset lever, governments themselves, large financial institutions, wealthy individuals who own a lot of scarce assets and relatively little debt, early adopters of whatever hard money is being elevated, whether it's gold in the 1930s or a mix of gold and digital scarcity in the 2020s. The losers are the ones who trusted the system in the most straightforward way. Savers who kept their wealth in cash, bank deposits, or bonds because that's what they were told was prudent. Pensioners whose retirement promises are funded by portfolios stuffed with government debt. Workers whose wages lag price changes. Landlords with variable rate loans. Small businesses with thin margins and little pricing power. The broad middle that doesn't have a seat at the table where the reset rules are written. In Rome, it was soldiers paid in increasingly debased coins watching their pay by less each campaign. In Weimar, it was professionals hauling salaries home in wheelbarrows. In 1930s America, it was citizens who turned in gold legally and watched its official price jump after they were banned from owning it. In your era, it's you scrolling through your banking app, seeing the same numbers on the screen, while your life gets more expensive every quarter. Maybe you're thinking, okay, but what am I supposed to do? I'm not a central bank. I can't revalue anything. You're right. You can't rewrite the script, but you can choose whether you're an extra or a player who survives the final act. Historically, people who made it through monetary resets with their purchasing power intact did a few things differently from everyone else. First, they treated national currencies as tools, not as sacred objects. They used them for transactions, but they did not rely on them as long-term stores of value. When they had surplus, they converted part of it into forms of wealth that weren't easy to dilute: land, metals, productive businesses, later on well-chosen equities, or scarce digital assets. Second, they avoided being the ones holding the bag of nominal promises. Long-term fixed income claims in a currency that's about to be engineered weaker are poison. If the reset is coming, you do not want to be the generous lender. Third, they diversified across borders and systems. When one state changed the rules, they had at least some wealth parked under different rules: a bank account in another jurisdiction, property in another legal system, income streams in different currencies. Fourth, they invested in skills and relationships that had value independent of any particular monetary regime. When money systems wobble, people still need food, shelter, repair, care, security, knowledge. The ability to provide those, combined with a network of people who trust you, becomes a form of wealth no central bank can print or devalue. You don't need to turn into an apocalypse prepper to take this seriously. You need to recognize that a sovereign debt crisis solved through monetary engineering isn't a niche concern. It's the backdrop of your adult life. Let us be brutally honest. There is almost no politically painless way to deal with multi-trillion-dollar debts and rising interest costs. The arithmetic doesn't care about election cycles, so policymakers will do what they've always done: choose the path of least visible pain, even if it causes maximum invisible damage over time. They will not call it theft. They will not call it default. They will call it policy. You are not required to approve, but you are required to adapt if you don't want to be crushed. That might mean allocating a fixed percentage of your net worth to hard assets, not because you worship them, but because they are the lifeboat when the ship's hull is being sawed through. It might mean refusing to hold long-duration debt instruments issued by an entity that is openly incentivized to devalue its currency. It might mean opening accounts in jurisdictions with saner fiscal positions, even if you never move there physically. Most of all, it means dropping the comforting story that they would never let that happen here. They already did, in softer versions. Negative real interest rates for years, silent debasement of savings, asset bubbles that transfer wealth up the ladder. None of this was accidental. It was always about managing an unmanageable structure. Maybe you want to believe that this time, somehow, the pattern breaks, that a government drowning in obligations will suddenly choose radical honesty, admit the debts can't be paid in full, restructure them openly, cut spending, reform pensions, tax fairly, accept short-term pain for long-term stability. History doesn't say that's impossible. It just says it's rare. Far more often, the story ends with what you rehelik. We're already seeing hints of slow-motion currency decay disguised as sophisticated policy, a quiet drift toward hard assets by the very institutions telling you to remain calm, and eventually a big bang adjustment where some mix of gold digital reserves and other strategic assets are marked up dramatically. At that moment, you'll see headlines about historic reform and restoration of confidence. You will not see headlines that say, "We just used a revaluation to erase a huge chunk of our real debt, and we paid for it with your lifetime savings." But that's what will have happened. Let's be clear, this isn't about hating any particular country or currency. It's about understanding incentives. If you were sitting in that chair with those numbers in front of you, under that political pressure, you would be tempted to do the same thing. The system pushes its stewards toward debasement because open default is fatal to their legitimacy. So you can't outsource this to them. You can't hope that the people who benefit from devaluation will protect you from it. You have to read the pattern yourself. You have to look at Rome's coins, Weimar's banknotes, Roosevelt's gold order, and the modern rush into reserves. And you have to say the quiet part out loud. They are not going to pay this back in money that feels like today's money. They are going to change the money. Once you accept that, the choices become clearer. Hard assets over paper promises, distributed exposure over single system dependence, skills and networks over blind trust. Maybe you're thinking, but what if I'm wrong? What if the reset doesn't come? Then you'll own some hard assets in a world where governments still overprint and central banks still experiment. You'll have some international diversification in a world where geopolitical risk is rising. You'll have skills and relationships that make your life richer, no matter what happens to some line on a central bank's balance sheet. That's not a doomsday bet. That's basic prudence. The real risk isn't preparing for a reset that doesn't fully materialize. The real risk is standing still, fully exposed, in a system that has already told you through its own behavior how it plans to survive. There's a pattern in monetary history that wipes out savers, hollows out the middle, and resets the scoreboard in favor of those who saw it coming. And right now, in your lifetime, the United States is following that pattern step by step, press conference by press conference, policy paper by policy paper. Maybe you want to believe this time is different, but the pattern says otherwise. The math says otherwise. History says those who hold the wrong side of the trade get sacrificed. So the only question left is not what they will do, it's what you will do before they do it.